Do you like the idea of getting paid to invest? How about getting paid even more money than you were getting paid before? Want to know about companies that are giving their shareholders pay raises? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I'm a huge advocate of dividend growth investing. This is a long-term investment strategy whereby you buy and hold shares in world-class businesses that are paying out safe, growing dividends to their shareholders. This strategy is awesome for many reasons. One of those reasons, you're literally getting paid to invest. Not only that, you're getting paid more and more money. That's right. High quality dividend growth stocks are like the golden geese that lay ever more golden eggs. These businesses continue to rack up higher profits year in and year out, and they continue to pay out higher dividends year in and year out. Because what's better than totally passive dividend income? Totally passive dividend income that's growing. This allows your purchasing power to keep up with or even outpace inflation, which is really important over the long run as things do continue to get more expensive. Today, I want to tell you about 3 dividend growth stocks that just increased their dividends. Ready? Let's dig in. The first dividend increase I have to tell you about came from Verizon Communications Inc., stock ticker VZ. Verizon just increased their dividend by 2%. I know, 2% isn't much, but here's the thing, it is more money. Not only is it more money, it's more money for doing absolutely nothing other than continuing to hold stock. Tough to complain about that. This is the 17th consecutive year of dividend increases for the telecom giant. Verizon is nothing if not consistent. This 2% dividend increase is almost the same as last year's dividend increase, and it's right in line with their 10-year dividend growth rate of 2.6%. So it's not a huge growth play. Instead, Verizon is more of an income play. The stock yields 4.6%, and that's more than 3 times higher than what the broader market yields. A big, dependable dividend like this in a low-yield environment is relatively appealing. Speaking of dependable, the payout ratio is only 53%. It's been said that the safest dividend is the one that just got raised. Verizon is in a great position to continue growing its dividend for years to come. This stock has been an underperformer, now down about 6% on the year. And that past underperformance could be your future opportunity. Most basic valuation metrics are below the respective recent historical averages. The 4.6% yield is 40 basis points higher than its 5-year average, and the price to cash flow ratio of 5.9 is well below its 5-year average of 7.2. Verizon won't get you rich overnight. It's not that kind of stock. But if you're looking to safely boost the overall yield of your dividend growth stock portfolio, Verizon is worth a good look. Next up, let's talk about the dividend increase that came courtesy of National Storage Affiliates Trust, stock ticker NSA. National Storage Affiliates just increased their dividend by 7.9%. Almost 8% more money for sitting on your hands? Yeah, that's pretty sweet, but check it out, it gets sweeter. This is the second time this year that this company has increased its dividend. This follows up on an 8.6% dividend increase last quarter. How's that for a golden geese laying ever more golden eggs? This is the 7th consecutive year of dividend increases for the self-storage REIT. The Real Estate Investment Trust continues to hand out generous dividend increases like clockwork. Their 5-year dividend growth rate is 20.1%. That huge dividend growth comes on top of the stock's yield of 2.8%. It's an extremely compelling combination of yield and growth, and the payout ratio is 77.4% based on midpoint core funds from operations per share guidance for this fiscal year. A touch high, but nothing crazy. This stock has been a barn burner, up 70% this year. The outstanding performance deserves to be commended. However, a lot of valuation metrics now look stretched, unfortunately. This is always the dilemma for investors. Investors want extraordinary performance from stocks, which can lead to high valuations, which then leads to lamenting. Shares are trading for a price to cash flow ratio of 22.2, which is high for a REIT in general, but that looks even more extreme when compared to its own 5-year average of 12.8. There's a lot to like about this stock, but the valuation valuation is unfortunately not one of those things. Keep an eye out for a nice pullback here though. Last but not least, let's talk about the dividend increase that came in from EastGroup Properties Inc., stock ticker EGP. EastGroup Properties just increased their dividend by 13.9%. Where else are you going to get nearly 14% more money for doing almost nothing at all? I don't know if I ever got a 14% pay raise from my old day job back before I quit in my early 30s, and even if I would have received a 14% boost in my pay, it would have only come about because I was coming in early, staying late, and working as hard as possible. Shareholders get the same result without lifting a finger. The Industrial Property REIT has now increased its dividend for 10 consecutive years. And the Real Estate Investment Trust celebrated a decade of dividend growth in style with an outsized dividend increase. Their 10-year dividend growth rate of 3.9% shows you just how outsized this increase was. And with the stock yielding just 2%, you really do want to see pretty strong dividend growth. It's worth noting that the payout ratio is only 61.3% based on this fiscal year's midpoint guidance for funds from operations per share. That's actually quite low for a REIT, which only increases the dividend's safety profile. This stock is up 40% year to date, and it looks pricey here. Every basic valuation metric I know of is well above its respective recent historical average for this stock. The price to cash flow ratio, for example, is coming up on 34. That's eye-watering. Compare that to the stock's 5-year average price to cash flow ratio of 22.2. So this is a stock that's typically commanded premium valuation, but the current valuation has gone beyond premium and is now in stratospheric territory. That's had the effect of lowering the yield, which is now 70 basis points lower than its 5-year average. I'd be on the lookout for a sizable pullback in this name before investing, but if such a sizable pullback does come, make sure not to forget about this REIT. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these dividend increases. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.